Imagine having enough cash sitting in your bank account to buy nearly every single company in the S&P 500. 480 of them, to be exact. Not invest in them. Buy them outright. That's not a hypothetical. That's Berkshire Hathaway's checking account, right now, in 2026. $397 billion. Sitting in cash and short-term U.S. Treasury bills. Not deployed. Not invested in a single new stock pick. Just waiting. And here's the part that should stop every retail investor in their tracks. This isn't Warren Buffett panicking. This isn't fear. This is, by his own framework, the most disciplined position in the history of his company. Today, we're breaking down exactly why Berkshire is sitting on more cash than the GDP of an entire country, what it actually signals about where we are in this market cycle, and most importantly, what an everyday investor in India or anywhere else in the world should actually do with this information. Because hoarding cash like Buffett isn't really the lesson here. The lesson is something much deeper. Let's get into it. Let's start with what's actually on Berkshire's balance sheet, because the headline number alone doesn't tell the full story. At the end of the first quarter of 2026, Berkshire reported $397.4 billion in cash, cash equivalents, and short-term treasury bills. That's up from $373 billion just 3 months earlier. And it didn't happen by accident. Break it down and you find roughly $51 billion in plain cash and equivalents, actual bank deposits, money market funds. But the real story is the other $339 billion, sitting in short-term U.S. Treasury bills. Berkshire isn't just holding cash. It has effectively become one of the largest private holders of U.S. government debt on the planet. And this didn't happen overnight. Between 2022 and 2024 alone, Berkshire sold a net $173 billion worth of equities. Buffett trimmed the Apple position from nearly half the entire portfolio down to about 22%. He cut Bank of America by more than half. He sold down Amazon. Quarter after quarter, the pattern was the same: sell expensive assets, don't replace them with anything, let the cash pile up. In the first quarter of 2026 alone, Berkshire sold over $24 billion in stocks and bought back only about $16 billion. Still net selling. Still net hoarding. Even with new CEO Greg Abel now formally at the helm, the playbook hasn't changed one bit. So why would the most successful investor of the last century choose to sit on a stack of cash that's actively underperforming the market? The answer comes down to one word Buffett has used his entire career: price. At Berkshire's annual meeting in May 2026, when asked directly about deploying this cash during a market pullback, Buffett didn't sound like a man rushing for the exits to buy the dip. He told CNBC's Becky Quick that a market decline of 5 or 6% simply wasn't enough to get him interested. In his words, that kind of pullback doesn't represent the kind of mispricing he's looking for. Think about what that actually means. Most retail investors see a 5% dip and either panic sell or panic buy. Buffett sees a 5% dip and shrugs. To him, that's noise, not opportunity. He's not interested in being slightly less expensive. He's interested in being obviously, undeniably cheap, the kind of valuation gap that only shows up a handful of times in a generation. And there's a second piece to this. Berkshire's size has become both its superpower and its prison. To meaningfully move the needle for a company this large, Buffett and now Abel need deals in the tens of billions of dollars. Small bargains don't matter anymore. And in a market where companies like Nvidia, Microsoft, and Meta have been trading at valuations driven by an AI-fueled rally, the math simply hasn't worked for Berkshire's strict valuation discipline. Meanwhile, that idle cash isn't doing nothing. Parked in treasury bills yielding around 3.7%, Berkshire is on track to collect somewhere around $12 billion in annualized interest income. Just for waiting. Just for saying no. Now, here's where it gets controversial, and you've probably seen this argument online already. Critics point out that Berkshire underperformed the S&P 500 by roughly 11% in 2026. And the explanation is straightforward: a $397 billion cash pile earning treasury yields while the broader market, driven almost entirely by a handful of AI-linked tech giants, kept climbing. Berkshire's old economy tilt toward railroads, insurance, and energy meant it simply wasn't in the rooms where the AI boom was happening. So was Buffett wrong? Here's the thing people miss when they run that opportunity cost calculation. It assumes Berkshire could have simply bought the index instead. But that was never the mandate. Buffett's job, and now Abel's job, was never to track the S&P 500. It was to buy entire businesses, or substantial stakes in great businesses, at sensible prices. That's a completely different game with a completely different risk profile. This is actually a really important lesson, because it's the same mistake many investors make when they compare their own portfolio to a friend's crypto gains or a neighbor's hot stock tip. Different strategies have different jobs. Buffett's job has never been to maximize short-term returns. It's been to never permanently lose capital, and to be positioned to act decisively when the rest of the market is in fear. History actually backs this pattern up. Buffett built up large cash reserves in 1999, right before the dot-com crash. He built one up again in 2007, right before the financial crisis. In both cases, he looked early, and arguably out of step with the market, right up until he wasn't. So strip away the noise. What is this $397 billion fortress actually signaling? It's not a prediction of an imminent crash. Buffett himself has been clear he's not in the business of timing markets. But it is a valuation signal. It's the most successful capital allocator alive telling you, through his actions rather than his words, that broad market prices currently don't offer him a margin of safety large enough to risk permanent capital. And here's why that matters even if you're managing a few thousand rupees instead of a few $100 billion. For investors in India tracking the Nifty or the Sensex, this is a useful mental model, not a literal instruction to sell everything and hold cash. SIP investors, in particular, don't need to mimic Buffett's market timing instincts. The entire power of a systematic investment plan is that it removes the temptation to time entries and exits in the first place. What you can take from Buffett's playbook is the discipline behind it. Know what you're willing to pay for a business, don't chase prices just because everyone else is buying, and treat a market pullback as an opportunity to evaluate quality, not as a reason to panic. The mistake most retail investors make isn't holding too much cash. It's having no price discipline at all, buying because a stock is going up, and selling because it's going down. Buffett's $397 billion isn't a call to hoard. It's a demonstration of what real conviction about valuation actually looks like when you have the patience to wait years, not days, for the right price. So here's the real takeaway. Warren Buffett isn't sitting on $397 billion because he's scared of the market. He's sitting on it because he refuses to compromise on price, even when that means underperforming for a stretch and absorbing criticism for it. That's a much harder discipline to practice than it sounds. Most of us, watching a market rally without us, would feel pressure to jump in. Buffett's entire career has been built on resisting exactly that pressure. The next time the market pulls back and your instinct is to either panic or chase, ask yourself the Buffett question: is this actually cheap, or does it just feel like a deal because everything else went up first? If this breakdown helped clarify what's actually happening at Berkshire right now, hit subscribe, and let me know in the comments. Do you think Buffett and Abel are right to keep waiting, or has this cash pile already cost them too much? I read every comment, and I'll see you in the next one.